when you go to underwrite a deal, you need to know how taxes are going to be reassessed post acquisition. And that varies state by state, potentially even by county by county. But I always say there are three major levers for what can kind of make or break a deal.
Hello, everyone, and welcome to the podcast. Today, we're going to talk about the 5 common mistakes people make in multifamily investing. Joining me is Nathan Loy, who is the Director of Strategic Planning at Viking, and I'm your host, Ravi Gupta, the COO of Viking Capital Investments. Welcome, Nathan.
Thanks, Ravi. Happy to be here.
Absolutely. Happy to have you as always. So let's get started. Tell us about the 5 mistakes that people make in investing in multifamily.
Yeah, absolutely. So we talk a lot about multifamily. We talk about all the great returns and the upside, but as you know, with any investment, there's always kind of a risk profile that you have to be aware of and kind of analyze as you go into investment. So on the multifamily side of things, there are really kind of 5 primary mistakes that I see investors make, especially earlier on, but I've also seen this happen with kind of more seasoned investors as well. So the first one is, investing in a property that has poor cash flow. So they always, used to say that cash is king. Now the saying's kind of changed and adapted to cash flow is king. The way I think of it is if you're looking for retirement, right? It's a lot easier to have assets that produce cash flow than it is to stockpile cash itself. So that's one thing. Now, if you're investing in a new construction deal, you should expect minimal cash flows those first few years. But if it's like a value add deal or a core plus deal, you want to hit the ground running day one with consistent cash flow. One, for the property level, but then also for kind of distribution for you as the investor itself. Secondly, is investing in markets with poor organic appreciation.
Well, let me comment on that first point, Nathan, because what you said is very important. People really enjoy those checks that come in every month when they invest in a good multifamily investment, real estate investment. And that's one of the benefits of investing in real estate is that you do get that cash flow. Whereas investing in stocks, for example, that aren't dividend yield stocks, where you're just counting on this appreciation of the stock, and you don't know really when to sell, you don't know how long to hold. You see that the overall value of the stock may be really high at one point, but then it dips, and you're like, oh, I lost all the appreciation there. The great thing about investing in real estate is that you get that cash flow. And not only is your money appreciating in value, you're also able to take that cash and use it for other types of expenditures. There are some people that invest in multifamily, or not in multifamily rather, but just in real estate without expecting cash flow, which I don't think is a good idea. For example, those that are buying single family homes, a lot of my friends ask me this. They're like, oh, this home looks, it's a great area. I'll put money into it. I'll get a renter. I'm not going to make any money for 30 years, but I'm going to hold it for appreciation and I'll sell it and it'll be my retirement. Well, think about that. I mean, you're putting such a huge chunk of change into some asset that is not going to give you anything over a 30-year period. And then you're selling it based on what you hope will happen in the future. It's really, not the best strategy. Even if you're paying off that debt over time, it's still, you're holding on that too long. And there's the time value of money, right? And we can talk about that in just a little bit, Nathan, like, what an IRR is. But there's a time value of money. So you want to make sure that you are constantly getting that cash flow in whatever type of investment you're making. So, and Nathan, maybe you could just briefly tell us what IRR means and why do institutions actually value that more importantly than a annualized return?
Yeah, absolutely. So IRR is a return metric that takes into account the time value of money. And when me and Robbie are talking about that, what we're talking about is that $1,000 today is not the same value as $1,000 3 years from now. Just by rule of inflation, the dollar amount's degrading over time. So you want to, in an ideal scenario, get your investment back as quickly as possible. And there's a whole kind of complex formula for what IRR is, but in general, it is a return metric of how fast your initial investment is returned to you over a certain period of time. So if I, invest $100,000 and it takes 1 year to return my $100,000 to me versus 10 years, the investment that returns my $100,000 in 1 year is going to have a higher return because my $100,000 hasn't been degraded over a 10-year period.
Right. So, so you can, a lot of people invest in an equity multiple. They say that, hey, they want to see a 2x equity multiple in 5 years, which is, it's fine. I mean, I invest, that way too, but most institutions invest in an IRR, and they want to see an IRR of like, X amount or higher, because they really value the time value. They value that time value very much, and they want to continuously invest their funds. And that, having those funds available is so important. And that's where cash flow comes in.
Yep.
Excellent. So, okay. So that was number one, poor cash flow. Let's get to number two.
Yeah. Second one is markets with poor kind of organic appreciation. We're seeing this even now, and especially in certain states. But the price, the value of your asset ideally should increase over time. As you're building that NOI and as you're building the income that that property is producing, you want that appreciation to also translate to the value of your property. So that when you go to sell it, obviously, you sell it for at a higher cost than what you bought it for. There's some states right now, like California, like New York, that are seeing a mass exodus of people and of employment, and that kind of has a trickle-down effect to the valuations of property values. Not to say those are poor markets, but they definitely have kind of seen more of a correction in pricing than some other markets, like those in the Sun Belt. The third one are poor debt options, or at least not applying the right debt vehicle to your investment. So there are a ton of different debt options that you could go with: fixed rate, floating rate, whether it's backed by government like a Fannie and Freddie loan or from a private bank. You want to find a deal that has the right risk and return profile for that debt. And that's kind of actually one of the benefits of, multifamily, is that you have these other debt vehicles, these other institutions investing alongside you. I've mentioned this, in previous episodes, but one of the largest investors in your deal is going to be the bank or some sort of financial leverage. So you definitely want to make sure that that is the right vehicle for that asset and for that investment. Yeah.
And Nathan, I'm just going to speak to both those points. The first, investing in markets with poor organic appreciation. This is something that's really important. And this is something where you have to focus on job creation, job growth, job diversification. In fact, it's always a good rule of thumb. We use this rule of thumb in that 20% of the jobs, or there has to be a max of 20%. Actually, editor, just edit this part out. 20% of. So, okay, start. Wait, hold on. My camera's all screwed up. There you go. Okay. So you can start from here. Okay. So one of our criteria is that at most 20% of a particular industry can be taken up in a particular area. For example, we don't want 20% of the jobs to be solely. I'm totally blanking here. Manufacturing. So we don't want solely 20% of the jobs to be manufacturing. Because say 50% was manufacturing and there was some issue with that particular product, then the economy would tank in that area. So we don't want over 20% unless it's med or ed, right? So medical or education, those are quite stable over time. So we're okay with there being higher amounts there. But you want to make sure that the area that you invest in has good diversity, good job growth, has an influx of people. In fact, this is something interesting that you could do. Just look up U-Haul data and see where the U-Haul trucks are moving. So if you see a bunch of U-Haul trucks moving to a particular area, like if you looked it up recently, you see a lot moving to the Sun Belt, a lot moving to Texas, coming from California, moving to Texas, et cetera. You'll know where those jobs are and where the growth is. So it's kind of a fun fact. And then moving on to number two, Nathan, you mentioned poor debt options. This has been a huge issue in recent past. So at the time of this recording, which is mid-June, we've seen some multifamily owners go under because they chose poor debt. They chose variable rate debt. They didn't have a good rate cap, which means they didn't have good insurance on the debt, so that if the rate went way too high, their debt service payment went up so high that they couldn't afford that debt service. So you want to make sure that whatever you're investing in has really solid debt, has a rate cap if it's variable rate, and has a long term. So like, if it's a 3-year term, that may be okay, but it's a little more concerning than some deal with like a 5-year term, 7-year term, 10-year term, because the longer term, the more you can hold, and you can withstand fluctuations in the markets, and you can have some stability. You can sell when it makes sense. The only downside to longer term loans is there's frequently prepayment penalties you have to make sure of. So if those prepayment penalties are there and they're very high and pricey, it could really turn the deal sideways. So you just want to be wary of that. But in general, long-term stable debt is better debt.
Yep. And then there's a few ways that, Viking is mitigating these risks, right? We're investing in value add projects, which typically have cash flow, potentially even core plus projects. We're investing in the Sun Belt, which is, a period of really kind of high growth right now. And we're also kind of exploring multiple debt options for each project that we pick up. On one of our latest projects, we sourced, I think, over 15 different types of debt to see what would be the most attractive for the project itself, kind of the health of the project, but then also for the investors and for the distributions as well.
Yes.
So the kind of
let's go to number 4.
Yeah. Second to last one is not adjusting for taxes. So, I see this with a few operators kind of in their early stages. When you go to underwrite a deal, you need to know how taxes are going to be reassessed post acquisition. And that varies state by state, potentially even by county. But I always say there are 3 major levers for what can kind of make or break a deal. Taxes, and that tax increase being one of them. Debt being the second option, whether it's, you're over leveraged and you have too high a debt service, meaning there's not enough cash flow left for the distributions. Or 3, the exit value or exit cap rate. It goes back to that kind of discussion of, that organic appreciation. You can make almost any underwriting work if you tweak those, but it's really about how do you get in alignment with what you're underwriting pre-acquisition and then how the property will actually perform post-acquisition, which kind of gets us into our last point of choosing a sponsor with a strong track record. So you want to choose.
Before we get into that last point, Nathan, I want to just add to that. When we started as a newer company, we were looking at this particular deal in Maryland, and we thought it was a phenomenal deal. It made a lot of sense. It was a student housing deal, very new vintage. We visited the property and it looked great. We looked at the underwriting. It looked phenomenal. It looked like the deal was going to cash flow. We were about to sign in as a co-GP on that deal. It was sponsored by another group. And before we did, we're like, wait a minute, let's just check to see what the taxes are going to look like in the future. The sponsor told us that they already did so, but they didn't hire a tax consultant to do it. And that's the key point. You have to hire a tax consultant. You need to have someone specialized in this to do that type of work. Well, they didn't do it. And we really didn't know better, but we called the tax assessor's office instead. And luckily we got the information that the taxes were in fact going to double in the next year. And we literally at the 11th hour, we pulled out of that deal entirely. And we're so glad we did, because when the taxes would double on that deal, it made the deal not make any sense. And in fact, we didn't really follow up, but we're quite sure that that particular sponsor had significant difficulty maintaining it because of that reason. So taxes in and of itself can actually break a deal. There are a lot of deals that go sideways because of tax increases. And not only is it important to understand where taxes are going, but it's also important to appeal taxes. So make sure your sponsor is aware and will, in fact, they should be aware of it, but they will appeal taxes on a yearly basis. Sometimes it doesn't make sense to do so, and the tax advisor will tell you that. But many times it does make sense, and that can save hundreds of thousands of dollars if done correctly.
Yep. Yeah. Taxes are kind of one of your largest expenses. So you want to mitigate that as much as possible.
Yeah. All right. Let's move on to number 5.
Last one. So the last one is choosing a sponsor without a strong track record. So you want to choose a sponsor that has been in the game, has been through, multiple market cycles, has a strong track record of closing on deals, great communication, kind of being transparent in their communication, as well as exiting deals as well. That's kind of what we call bringing a deal full cycle, is from acquisition all the way to closing, and then what they kind of do with those proceeds after closing. Do they 1031 it? When's their next kind of deal available to them? But ultimately, the sponsor is the one who really controls that deal. I've seen deals that look phenomenal on paper and were operated by a poor sponsor and the deal tanked. And I've seen the reverse too, where it wasn't a phenomenal deal on paper, but because of the strength and the diligence and the asset management capabilities of the sponsor, they're really be able to outperform their kind of initial projections. And that's something you want to see too, is what are they projecting versus what are they actually delivering on when everything's all said and done? Because that helps build that track record of, conservative underwriting on the front end, and then great operations throughout the whole period, and kind of being aggressive on the sales price to really kind of make it the most robust, healthy, but again, low risk investment possible.
Yeah, that's a very important point, Nathan. And we all have to start somewhere. We as Vikings started with with no track record, but we slowly built up to the point where we have a very solid one now. But the investors that invested with us took a risk on us. They really did. They weren't sure that we'd perform because we didn't have that experience, but we ended up performing and doing well and moving on and moving forward. And you may be in the situation where there are deals that look great and they make a lot of sense. But when you're investing in a new sponsor, just that you really have to be wary of the underwriting on that deal, because they don't have the experience. Potentially, they don't have the experience to do the best job, and they may not be making the right assumptions. But you want to make sure that they have guidance from someone that knows what they're doing. And I'll give you two quick examples. There's a particular sponsor that I invested in, relatively new. It was a smaller deal, and the deal is actually doing very well, but the sponsor did not communicate well. Like we wouldn't get monthly newsletters, wouldn't get any communication on a monthly basis. We'd have to reach out to him to figure out what's going on with the deal. And even though that sponsor did great, the deal is doing phenomenal, I will not invest with that sponsor again because he was not communicating well, and and he also was relatively new, and it just didn't make me feel comfortable. Whereas another sponsor, deal looked great, it made a lot of sense, everything looked good, but then the deal ended up going sideways because they missed a few things on due diligence, and they weren't prepared for potentially what would happen when they were turning the units over. This one particular sponsor I was thinking of actually lost the entire deal. They went bankrupt. They had to give it back to the bank. So, that can happen with any deal, but specifically, with someone that is a sponsor that may be inexperienced and not know how to properly underwrite and know what to expect. So that is a very important point, and probably one of the most important, if maybe even probably the most important of these five, because if you truly trust a sponsor, they've done very well, then they will know exactly what they're doing. They're gonna give you the cash that you need. They're gonna invest in an area that has great organic appreciation and job growth. They're gonna choose the best debt. They're going to always adjust for taxes, and you trust them, you know them, you give your money to them, and then you don't have to really think twice. Well, this was awesome, Nathan. I think this was very helpful for folks. Anything else to add before we end?
Yeah. Lastly, I'll kind of go back to what you were saying. That's the typical progression of most sponsors is they'll start off raising from friends and family, and then eventually bring their deals out to kind of the larger market. So there's nothing inherently wrong necessarily in investing in a sponsor that is as kind of early infancy stages, right? We all have to start somewhere, and it's a little bit of a catch-22 where you don't have the track record yet, but you are getting started. You have kind of skin in the game. One of the best things that you can do as an investor, if you are investing in a sponsor that doesn't have, a completely robust track record, is to educate yourself. That's one way is to really mitigate that risk, right? Understanding why they have chosen the market that they're in, the potential market fluctuations that are coming down, understanding the demographic that they're serving and how that might affect your repairs and maintenance or the damages or the collections of that specific deal, right? Collections are something that we really focus on in terms of, rent really drives multifamily investments. So you want to make sure that the demographic can support your business plan, and have they accounted for unexpected, items to arise? We've seen a tremendous increase in insurance and in payroll. Do they have kind of adequate reserves? Even if they haven't gone full cycle, if they hit the marks on these other aspects and you're aware of the investment, why they chose this specific submarket, why they chose a specific deal, and how that relates to the rest of the deals in the market in terms of rents and pricing, that really is a great way to, potentially minimize the risk of investing, even if they don't have that tremendously robust track record.
Excellent. Well, this was great, Nathan. Thank you so much.
Thanks, Ravi.